Welcome to another episode of Erickson TV. Kurt is here with Lauren. Hey, Lauren.
Hey, everybody.
Hey, Lauren. I was last month. I was at a conference with our co-advisor Matt's Money, and I met a speaker, Lee Seidman, who was the producer for 60 Minutes.
Right.
And he came up with a kind of how to be a more effective presenter of speeches and data. And one of the things that he said was that for positive things you talk about in your speech, people forget they forget about 75% of it after about 20 minutes.
That's not long. Not long.
And then for negative things, negative events in people's lives, people can remember those for up to 13 years.
Yeah, that makes sense.
So I thought what we would do is instead of talking about the positive reasons we invest in the way we do for our clients, what is the negative impact if you invest different from how we invest?
Exactly. Right.
And what we have here is how do we normally tilt our portfolios, which makes it different than most other portfolios.
Right. When it comes to stocks, we tilt to small value, and what that means is that we place a great emphasis on including smaller companies and distressed companies and the stocks of those companies in our portfolios, as opposed to simply investing in the largest U.S. companies, which is what most people do, or else just sort of investing in whatever the current fad is.
Okay, very good. And so I thought what we'd do is we would look at different asset classes. And so I started out, and this, by the way, this is for the last 20 years. This is 20 years from 1991 to 2011. And I thought we would compare it to T-bills, Treasury bills, which is kind of the what is a T-bill?
Yeah, so a Treasury bill this is what you would get if you had a very, very low risk portfolio, pretty much the lowest risk you could. So compared to the asset class that we tilt to, small value, as you can see, Treasury bills did not really do so well.
This is a negative 8.67% per year, not total. This is per year.
So this is how you want to think about it, that if you invested entirely conservatively, you lost 8.67% per year for 20 years.
Huge number.
Yeah.
And then now how the people that actually do invest in the stock market and maybe invest in active mutual funds, they tend to mirror the S&P 500 or the U.S. large Fortune 500 type companies. And what happened here?
Well, then if you simply invested in the largest U.S. companies, you lost 3.82% per year versus what you would have done if you invested in small value. That's a pretty big chunk of money to lose.
That's a big number per year. Then the next one is tech stocks. Tech stocks are popular because of the names, the Apple computers of the world. This is a diversified portfolio of tech stocks, and what happened there?
Yeah, people got excited about tech stocks. That was the flavor of the month for a long time in the 1990s. You lost 4.39% per year for the last 20 years if you invested in tech stocks instead of small value. Okay.
And then up to about 3 years ago, people always said that you never lost money in real estate.
No one says that now.
Yeah, REIT is basically a pooling of different real estate investments, diversified supposedly. What happened there?
You lost 4.4% per year. And for a long time, REITs were doing similar things to small value. But that ended eventually, and then small value pulled ahead. So this is how much you lost by following the real estate trend for 20 years.
Okay. And then the one that has the most advertisement per capita on the radio right now on TV is gold. What happened to gold?
Lost 8.5% per year.
For 20 years?
For 20 years.
Okay. So to sum this up and bring this home is that remember these numbers if you are one of those type of people that remember negative events, and that you're missing out on potential independent lifestyle by focusing on the wrong things.
That's right.
And we'll see you next time on Erickson TV. Bye now.
See you next time.